Good morning and welcome to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. The weekend seems to have brewed some further calm with respect to the debt ceiling discussions, as it seems there is some form of major progress happening towards its resolution. But let's keep that aside for a minute, as the old beast is back in the spotlight. The PCE on Friday came in higher than expectations, which led to the Fed watch repricing the rate hike probabilities. A hike in June is now being priced at almost 65%. Why is it significant? Only because there has been a sharp change in market expectations. Just a week back, the rate hike probability was only 17%, and now it's 65%. Good morning, JK. I would like your insight into this. Inflation doesn't seem to be cooling at the pace which the Fed was probably hoping for. What is your take on Friday's PC number? Do you think there will be a hike in June?
Good morning, Swaraj. Yes, but instead of looking at this month's change on the PCE core inflation, I would look back at the last 6 months' data. Annual core PCE inflation has been hovering between 4.6 and 4.7% after having hit 5.20 in November 22. So Fed may not be so much worried about this in the sense that they may still expect the inflation to come down, but that depends on the slowing down in consumption, and that is where the problem is, because all the data that we have seen in the last few weeks have been strong. Retail sales were improving, industrial production was improving, and the consumption, the personal consumption itself has almost doubled last month. So there may not be the tightness which they were expecting due to tightening conditions may not be to their satisfaction. At the same time, I still feel in June, despite what the market expects, they might skip a rate hike, expecting the impact of recent rate hikes to have some effect on the consumption. Also, after the debt ceiling deal is signed, there is an expectation of huge amount of bond issuances from the government, which will suck out a lot of liquidity. This may also actually slow down and tighten the conditions, which might, help them to hold off for a while. I'm not saying we have seen the peak in the rate. At the same time, there may also be a need to look at the upcoming jobs data on Friday, because employment sector has shown some deceleration in the last few months with various indicators. And also the monthly CPI number, which is due a day before the Fed announces its decision, also is forecast to be showing a small drop in almost all the parameters. So I think it's still not a given, according to me, as far as June rate decision is concerned. But definitely the peak may not be in unless we see a big decline in the economic activity before they meet in July. But coming back to the major happening over the weekend, President Biden and congressional Republican leader Kevin McCarthy reached a tentative deal on Saturday to raise the ceiling on US government borrowing. And it's a 2-year budget deal with a 2-year debt limit increase. Concessions were made with regard to Republican demands for increased work requirement for recipient of food stamps, and then holding the 2000 spending flat for 2024 and imposing limit for 2025. Roughly, even the non-defense spending were kept flat for FY23 and also in FY24, while factoring in agreed upon appropriation adjustments. No changes have been made in Medicaid, which the Democrats were very keen not to change. It's a deal still faces difficult part to pass, because many of the members of the Republican Party were not happy with the concessions that have been made in coming through with the deal. So while the market does think that deal will go through eventually, but it may not be a smooth affair, and there will be some jitters until it is finally passed by the Congress and signed by the president before the new deadline of June 5th that has been indicated by Yellen. And we presume that there will be some buying back of short-term T-bills and bonds that can happen immediately, because of the possibilities of debt deal being concluded. The yields on short-term T-bills had shot through the roof in the last few weeks, and that can actually reverse. But again, today is a US holiday, so we may not see the full reflection of market reaction to this deal. And beyond, the initial reactions, we are also aware that the market has already priced in an agreement to be made. So what investors will now focus on is the cost of the spending cuts to the health of the economy and how much impact these will have on the GDP and economic growth, which is important from a medium-term perspective. The raising of ceiling is also to be followed by issuance of nearly 1.1 trillion of new treasury bills over the next 7 months, according to some estimates, and that is really a very large number to contend with. So this would actually accentuate an already prevailing trend of deposit outflows, because if the yields start going up overall, then you might see actually smaller banks face that deposit crunch, and is really not a very straightforward relief rally across that we are seeing. There are many aspects that come into play once the deal is signed, because of the way things have been moving in regard to the liquidity position and also with regard to the inflation and growth. In fact, one of the Fed president, Cleveland Fed President Mester, said that as far as June is concerned, everything is on the table. So while even they have seen the inflation number on Friday, they are not really saying that June will be a rate hike. Although an individual member would not commit like that, but still, there seem to be some guarding statement as far as June recession is concerned. As far as the markets are concerned, US stocks rose more than 1% across indices, with smart investors discounting a deal to be signed. But also, there's an ongoing rally that's happening in the AI stocks, which is fueling buying every day. And although some people have already started to call it a bubble, but it is still early days, because it's a new sector that has started to gain importance. The good sentiment has passed on to the Asia also today, with many markets actually nearing a 1% gain. Major uncertainty has probably declined, and the US data has not shown any significant deceleration in the economy. That's also a positive factor for the stocks. Yields were higher on Friday after stronger than expected PCE core inflation, with the raised prospect of a rate hike in June. Twos were up 7 bps, 10 were almost unchanged, but 30-year came down by 3 bps. Effectively, yield curve has again steepened. It does appear that market is still worried about the economic prospects in medium term, as it is almost certain that Fed will raise rate either in June or July, going by the various data points. Despite higher inflation number, dollar made gains only against yen, and other remains flat so far. Euro and GBP dips have been bought into, but they have really not made any progress on the upside. Single currency looks weak and bides time for more losses, perhaps awaiting more cues from the economy. Not surprisingly, commodity currencies have had relief recovery, having been oversold for the last 1 week. However, the weakest currency pairs, yen and CNY, have been languishing at the lows. The former actually testing the authorities who have already started to make some noise about the weekend, while the latter is unable to hold on to even minor gains, with the economic news coming steadily weak. As far as the rupee is concerned, we have been seeing a slow drift down for the dollar, and like we were seeing resistance at every 10 paisa on the way up, we are seeing a similar supports coming at every 10, 12 paisa for the pair. So that's actually keeping the movement very small, and we have supported immediate support at 80 to 60 and 80 to 50. Eventually, with the big buying not coming in, and this positive sentiment today, particularly we have a US holiday, which means that there won't be any outflows that can help the rupee to some extent. So in the next few days, we might be able to see 80 to 50 or even 80 to 30 tested if the flows are there, and that's the best I'm seeing as far as the rupee is concerned, because we have the prospect of US yields remaining higher, and dollar index gaining more, and Chinese yuan not really, getting traction against the dollar. Today also we had a data from China where the industrial profits came down by 18%. So all in all, it's not a bull trend for the rupee. It's just a retracement of the losses that it suffered in the early part of this month. Yes, I think today is probably going to be a slow day because of the US holiday. In fact, UK is also closed today. So we'll have all the action tomorrow. By when we'll get a much better picture of the deal and the prospects of it going through the Congress. Thank you.
Thank you, JK. And just to quickly summarize, of course, even though the Fed Watch has repriced some of the rate hike expectations, we are observing data on consumption in the last few weeks being strong, retail sales, industrial production. So there is some tightness which is expected by the Fed, which is not materializing. But after the debt ceiling resolution, there may be new issuance of bonds leading to further tightening. So it is possible Fed might skip the June hike, emphasizing on the word skip. Debt ceiling negotiations, of course, there's a 2-year deal holding spending flat for 24 while reducing the spending in 25. Non-defense spending may be reduced. Investors may be focusing on spending cuts and the impact on the economic growth. On the equity front, AI stocks have started to gain attention from investors. We will observe how that theme plays out in the coming years. For the rupee, we are seeing some small dips lower, which supports every 10-12 paise. That's it from us today. US markets are closed today on account of Memorial Day. So it's a dollar holiday with no outflows. Tune in tomorrow for another round of fresh updates. Thank you so much for listening.